Hi, I'm David Scranton from the Income Generation, and thanks for clicking this video, because today we're talking about the markets. And historically, the fall season is often thought of as being a bad time for financial markets. And recently, we've seen an upsurge in volatility. So let's talk about what all this means for you and for your retirement. And because this is such a big task, we're bringing in Michael Eastham, founder of Fellowship Financial, located just outside of Orlando, Florida. Michael's the best-selling author of the book, Common Sense Income Strategies, and also an owner of a retirement income store. Michael, as usual, my pleasure to have you here and to discuss this topic about these volatile markets we've seen over the last few days.
Well, thanks for having me, Dave. It's always a pleasure to talk to you.
So what do you think is causing the surge in volatility all of a sudden, right? We had this great time. The markets were going up until like the middle of August, it seemed, because interest rates were low and the party was going on, and that's changed. We've seen even more volatility over the last couple of weeks. So what is it? Is it really just all about this company in China that's threatening to default on its debt?
Well, Dave, I think it's a multitude of factors, and it seems like this fall we have more factors than normal to think about with respect to the volatility. I mean, you can consider the debt ceiling argument on the U.S. side. You can think about interest rates. I mean, the Federal Reserve is curious. Yes, of course, on the global frontier, you've got the uncertainty about whether Evergrande is going to collapse, and if the Chinese government is going to bail them out in some way or restructure. You've got the ongoing dynamics in the Middle East, and again, you add to that the flavor or the headline of the day that could make investors' knees a little bit queasy. And I think that what that does, you throw all that in the blender, you push the button, and you've got a recipe for concern. And that's what those are some of the contributing factors that I see.
Now, the media actually blamed it on Evergrande and the company in China that failed, and some concerns about contagion. But I don't know about you, but I don't think that that's going to flow beyond China's borders in any meaningful way. Do you?
Well, the conclusion I've come to is that it will be isolated more in China or in some Middle Eastern, some more European areas. A lot of folks that do have direct exposure, they could be impacted, but none of our clients are really directly exposed. So the only thing that would affect us is if there's some domino effect that falls outside of China. And the tea leaves that I'm reading are really talking about it being more isolated within those regions that I talked about.
But I think what happens is, when you have a market that arguably is on the higher side in terms of P/E ratios, et cetera, that people are a little bit nervous, and you get any bad news out there and people react and start to take some profits and sell from the top. So I think that's a big part of it. But, the thing that amazes me is that all this talk about tax increases hasn't affected the markets per se, because when Trump got elected, it was all about, okay, we know he's going to lower tax rates, so the market should go up. So the market went up in anticipation of that, right? Because markets are forward-looking. But if markets are forward-looking, why haven't they been going down on anticipation of increased taxes? I really can't find an answer for that. What do you think? What do you tell people?
Well, because I don't think it's really whittled its way up to the top of the headline. You've got too many other skeletons that are sitting in the closet that people are more concerned about. Honestly, the questions that I've gotten more about are things like Evergrande or the Federal Reserve and those major things that are right in the front, that are on the headlines of major news media. And those are the things that are making people's knees wobble. It's not so much about the tax side yet, even though I have had a couple of questions regarding taxes, and especially for real estate investors, they're concerned about 1031s going away or capital gains taxes being affected. But by and large, it's been more on these other issues, primarily because there hasn't been enough banter about the overall impacts.
So interest rates, right? We know that generally speaking, low interest rates are good for the stock market because a stock analyst will take all the future earnings that he's projected from the company and he'll discount those based upon some interest rate. So the lower the discount rate, the higher the present value. The stock is worth more. I get that. But yet interest rates spiked in the first quarter of this year. I mean, the 10-year government bond, the yield on it almost doubled in the first quarter. In fact, it's higher than it is even right now. And right now it's gone from 1.25 to 1.5 in a matter of just a few days. But yet even with that increase at the beginning of the year, the stock market still didn't even have a hiccup. So is that going to be different now, do you think? Or is that a non-factor unless maybe rates go over some ceiling, like maybe, I don't know, 2% on the 10-year government bond? What are you thinking?
Yeah, I don't think interest rates are as big of an issue in people's minds, although they're thinking about it from more of a mortgage standpoint. They're not thinking about it from a stock market perspective. I mean, of course, Dave, typically when interest rates are headed up, that simply means we got issues on the economy side. And, the Federal Reserve is talking about possibly increasing short-term rates. So that, to me, is an issue where the Federal Reserve has more confidence in their ability to control the market than most investors do, most retail investors. So I really don't see that as being an issue. I think, as we've talked about before, interest rates for the foreseeable future are going to be relatively low. And if not, falling back down a little bit. We have seen a little bit of a spike here lately, but I don't believe it's going to go up too high. I mean, for the bottom line is that the federal government can't afford debt at a higher interest rate. So they've got a vested interest in trying to keep those longer term rates down.
True, very true. So let's summarize this then. A lot of analysts are saying the stock market's still got room to run. It's the best game in town. 2022 overall should be a good year. But there's more and more nervousness now about the possibility for us seeing a 10% pullback before the end of this year, maybe even a 20% pullback, possibly. So, for some, this might create a buying opportunity. But for others, if this happens, maybe they should take some winnings off the table now. So first of all, do you think that's a reasonable prediction? Do you have other thoughts? And then what do you tell our income generation members? What should they be doing in light of this news?
I do think a 10% pullback is possible. We've seen a couple of situations where we've had, 2% pullback, and that's happened pretty quickly. So I think it's very conceivable that we could see 10% over the next couple of months. I don't overall think that it's going to be a major issue, because when you think about our investment client, our typical clients, we've got clients that are invested, for the most part, they're invested more for income than for growth. And the investment vehicles that we have our clients in are more predictable. They're consistent in terms of paying out. So even though we may have a drop in the market value, that could be a buying opportunity for someone who doesn't need the income right now. And for someone who does need the income right away, we just continue to collect the income and then pay it out to them. So those are the conversations we're having with respect to the variety of clients on the income side.
So if you are satisfying your income needs, or will be able to in retirement satisfy your income needs from interest and dividends, no need to lower your risk necessarily, because you can withstand a dip. But if the other side of it happens where you're not quite there, then you might want to take some money off the table now to put yourself in that position, which is, I guess, always good advice. So the real answer is, don't do anything radical on headlines, which is usually the best advice. Michael Eastham, thanks so much. It's been great talking with you again.
My pleasure. Thanks so much, Dave.
And thank you for watching this video. If you enjoyed this interview, make sure to click the thumbs up button to give us a like. And don't forget to subscribe to our YouTube channel for more interviews with financial advisors around the country.